Hello friends, I was probably 11 years old when I learned my first financial market lesson, but I didn't know it that time. Manmohan Desai released his super hit movie Amar Akbar Anthony, if my memory serves me right, in 1977. And I heard a song, My Name is Anthony Gonzalez. Mr. Amitabh Bachchan sang something in the song which is the bedrock of the financial sector service. By the hemoglobin of the atmospheric pressure in the country, and all the girls going, wow! By the hemoglobin of the atmospheric pressure in the country, there is no such thing like that. He just said it to floor the babes. And guess what? This is what happens in the financial sector services. People jargonize things, they make them complicated, it makes the entire statement look very intellectual, and the person appears to be very knowledgeable. Now that is basically something that, like I said, the financial services are good at. But take a look at what Aditya Puri used to say, and I read that in a book by Tamal Bandyopadhyay, clearly the leading author on banking in India. He wrote about how HDFC Bank was born, and the very first chairman was Aditya Puri, who was famous for not keeping a computer in his office. And he took this bank from zero to the fastest growing, largest private sector bank in the country. His catchphrase was to his employees, "Tu mujhse अंग्रेजी में बात मत कर, मुझे हिंदी में समझा," which means don't talk to me in complicated jargon. Talk to me in simple language that I can understand. Now that is what good leaders do. They make things simple. So I'm going to explain to you in very simple language what options delta is without the jargon that you are used to hearing from the finance sector. Now I hope you enjoyed the first video on options. I basically made a case of why writing options gives you a better chance of succeeding as compared to buying options. I gave you some examples there, but please remember one thing. Do not try to put in trades in options without mastering the business first and watching the entire series of these videos. And only then should you go out there and venture a trade. Many of the examples that I give you are just hypothetical examples not to be traded on. I'm just explaining the concepts to you. Now in delta, what is delta? This video is made up of 6 parts. What is options delta? And part 2, is delta good when the reading is high, or is delta bad when reading is high? Which means, would you want high reading of delta or a lower reading of delta? Part 3, how do you compute delta? Part 4, options delta for traders. Different kind of traders will want different kinds of delta. Now, number 5, is delta the be all and end all of options trading, or is there something different or maybe even better? And of course, is it free? And number 5, how do you use delta and options premium to know whether that particular options premium or that strike price is giving you a reading which is mispriced? And mispricing would mean that the price will come back to normal, and when the price moves back to normal, you can always make money. So is there mean reversion happening? These are the 6 salient points of this video, and I start off with what is options delta. Remember, this is without all jargon. Now, delta is basically the movement in the price of the option compared to the movement in the price of an underlying security. For example, if you're an options trader in the Nifty, all right, so if the Nifty spot or the Nifty future, say for example, the options in India are based on the future. So the underlying is the future here. So if the future is moving 10 rupees in the Nifty and the option premium is moving 10 rupees also, that means the delta of that particular strike price is 1. However, if the price of the Nifty future is moving 10 rupees and the options premium is moving by only 5 rupees, the delta is 0.5 or half. It's not really complicated, is it? It can't get simpler than that. Typically speaking, the delta of an option tends to be lower than the future. Options tend to be a little more slower than futures. Now, are options all similarly slow? No, it's not. For example, if you're trading a strike which is at the money, which means the Nifty is 25,000 and the strike price is 25,000. Here there is no uncertainty. Both are the same. Here you will find delta to be approximately 0.5. But if you go in the money, so say example, Nifty is 25,000 and you're buying a call of 24,000, you already have an advantage of $1,000. Here your delta will be higher, significantly higher, probably 1 or closer to 1. Now, is delta always between 0 and 1? That is only for calls. If you are buying a call, delta is positive. If you are selling a put, which means going long again, delta is positive. If you're buying a put, which means going short, delta will be between 0 to -1. And if you're writing a call, which is again going short, delta will be between 0 and -1. Now, I'm sure you've all understood what I was trying to tell you. Delta is nothing but the extent of the move in the premium of an option as compared to the move in the underlying asset. I now move to the second part. Now the second part is delta good when the reading is high or is delta bad when the reading is high? Hey, there's no such thing as one size fits all in the financial markets. You've heard of that old saying, what's good for the goose may not be good for the gander. So what's good for him may not be good for me. Why? Because we could be looking at different things at any given point in time. If at all, you are a short-term trader, probably even an intraday trader, you will obviously want something that moves fast. You want to get in, get out, get in, get out. All right. If you're a scalper, if you're a day trader, if you're a micro trend trader, micro trend traders are people who do not keep their trades open for more than 59 minutes and 59 seconds, which is 1 hour. In case you're a short-term trader, then you would want a higher delta option strike because you'll move in and you'll move out fast. You do not basically want to keep an open trade at the end of the trading session. You want to go what is called flat out. Going flat out means you've closed all your books, you've closed all your trades, and you have no outstanding open trade when the closing bell rings. If you're that kind of a trader who goes flat out by the end of the day, you will want higher delta strike prices and higher delta stocks or maybe securities. But if you're a swing trader, if you're somebody who is playing for rolling over his trade to another day or maybe another week, in that case, you may want a lower delta. Why? I will come to you in the next point. Different deltas for different kind of traders. Point number 3, how do you compute delta? I believe in an open source society. Open source society is people who believe that most of the things should be free in the open domain, which means your softwares, your mobile apps, your other applications in life, even to self-help and do-it-yourself kind of help should be free. Which is why I make videos that are free and I don't charge for any services at all. I don't provide any services in spite of being a SEBI registered research analyst. Now, obviously, you would want to calculate delta for free. As per SEBI law in this country, Every brokerage firm needs to have a couple of data points updated every single day on their websites for their investors, clients, and public at large. Daily span margin is one of them, and options premium calculator is the other one. Now, I have chosen Upstocks not because I have any kind of financial dealing. I don't even have an account with them. I don't have any pecuniary or financial give and take with them. You could be absolutely free to choose any other brokerage firm's options premium calculator. I remind you, this is just for illustration purpose at all. There is no vested interest here. Now, what you do at the time of calculating the delta is, as you can see on your screen, you basically need to fill in the strike price of the option that you want to compute. And then you put in the underlying price, which means if you're trading the Nifty, you will want to put in the strike price of the Nifty, say 25,100. And the underlying price, if the future is trading at 25,000, you could put in 25,000 level there. Now, days to expiry. Why do you want to do that? Because obviously, like I told you in the first part, in options trading video part 1, options premium is entirely dependent on the cost of money. So obviously, when it is the beginning of the month, you're calculating interest for the entire month. But if you're in the middle of the month, when days to expiry are half, your options premium will also have to halve. So days to expiry is something you will have to be very careful and putting in the right figure. Then risk-free rate or the rate of interest. Now it is safest to put in the Indian 10-year benchmark bond yield prevalent on that particular day. You can get it all for free on TradingView. The ticker code is given right here on your screen. Okay, so at this point in time, as I speak while recording this video, the Indian 10-year benchmark bond yield is 7%. Then the dividend yield. What is the dividend yield of that particular company whose stock you're trying to trade in the options segment? And then the implied volatility or the statistical beta. Now, where do you get this implied volatility and statistical beta? Here again, luckily, there's help at hand, thanks to people like me who believe in an open source GNU society. Number one, you can Google search it. Number two, you can get it from your desktop trading terminal. I'm not very sure about mobile terminals because frankly, I don't use the mobile trading terminal unless I have to. I absolutely have to stay away from my office den and move out during trading hours. So the desktop terminal will invariably have a lot more features compared to your mobile or your tablet. All right. So desktop terminals will definitely give you the implied volatility and delta of your brokerage firm trading terminal. So there are many ways you can get that implied volatility or beta. Now, the higher the volatility, implied volatility or statistical beta. By the way, I prefer statistical beta more than I prefer implied volatility. So higher the statistical beta or the implied volatility, higher will be the premium. Now here is what many people ignore. If the premium is very high because of high volatility and nothing really happens to the price, the premium starts to shrink very fast. The closer it gets to expiry, remember DTE, days to expiry. The closer you approach to expiry, the faster is the decay or shrinkage in the premium. Options are a time decay instrument. And the closer you get to expiry, the faster the premium falls flat. So option writers in that case stand to make more money in going in for those options where the premium is extremely high. This is a tip you're unlikely to get in too many places. Make a note of that. Where options buyers are concerned, they would be advised to get out of these high premium trades, preferably by the end of the trading session, because these are highly volatile counters, which is why the implied volatility and statistical beta is high. If at all something goes wrong on the next trading session, which it can, you stand to lose a significant amount of money. By the way, trading derivatives is a highly risky activity. Substantial losses in capital can occur. Treat this as a statutory come friendly warning from one real world trader to you as a real world trader. Now, different kinds of delta for different kinds of trader in part 4. All right. Now, day traders will obviously, like I said, want to get out, and therefore they will basically want higher delta. And higher delta will come from either strike prices which are at the money or in the money. Remember, out of money strikes will have very small delta, which means even if there is a profit accruing, it might be so small that you may not be able to cover in your brokerage cost, commissions, execution costs, taxes, etc. Do remember, unfortunately for us, the STT or securities transaction tax in options trading is higher than STT charged in futures segment. So you already have a handicap. Your hands are kind of handcuffed where charges are concerned. So you basically want a bigger bang for your buck. Either as a day trader, stick to at the money or in the money where delta is higher. And if you're an options writer, if you are somebody who is a swing trader who's carrying his trade forward to the next day, you will want a low delta. Why? Because tomorrow when the market opens, something could be in the news which would be against you. At that point in time, supposing the delta is 0.2, the stock moves $100 against you, you will lose not $100 in the options premium, but 20 because the delta is 0.2. Remember, you're a writer. If the delta is low, towards the end of the settlement, the premium is as it is going to shrink all the way down due to dead weight on its own, due to gravity, come to zero, which means you're going to pocket all the money, which is what option writers do. I frankly am a writer. I believe in writing options, even if it means higher capital deployment by way of span margin, concentration margin, exposure margin, and ad hoc and extreme loss margins. I treat that as principal. The premium that I receive is the interest. As long as, a friendly tip here, as long as your payoff is close to or higher than 2% a month, try to avoid that particular strike. Because at some point in time, you will lose money in some trades. So unless the risk you're taking is giving you 2% yield per month or higher, it's not worth taking. Don't kill yourself for 1% or 1% a quarter per month and take home 12 and 15% taxable. Remember, as a business owner, you and me will also have to face the tax man. So let's take from the table, which after paying our taxes leaves us a sufficient amount of money to put food on the table for our family. And why just look at bread and butter? Once in a while, you also need jam and chocolates. So plan well. There's a video that I've made on how you should not be focusing on small profits and aim for smaller exposure with bigger payoffs in your trade. You can see the thumbnail on the screen. The hyperlink to that video is in the description below and in the pinned comment below. Now, segment 5. Is there a better viable alternative to Delta? Because, hey Vijay, I found Delta very confusing. I'm a senior citizen, I'm a housewife, I'm not a finance professional, I'm a college student, and I'd like to cut out the clutter, suggest something different and something that will do the same job, simple and for free. Yes, I believe in an open source GNU society where things are free. So yes, there is an alternative available. It's called correlation coefficient. If you're a mathematics and statistics student, you can compute it in Microsoft Excel. If you don't even want to do that, no harm done. go to tradingview.com. I've taken ACC's correlation coefficient and I have used the Nifty as an anchor point. Now the Nifty is the anchor and the ACC stock is what I want to trade. So this is how, what you can see on your screen, I will calculate the correlation coefficient. As you can see, ACC's chart is open and I said plot coefficient, correlation coefficient. It asks me the anchor point or the comparative study. I added Nifty to it. And as you can see on your screen, the correlation coefficient reading is 0.87. Now, what it very simply means, remember Aditya Puri, tu mere saath English mein mat bol, talk to me in Hindi. Means don't talk to me in complicated jargon. Make me understand in a language that I understand. Very simply put, if the Nifty is moving 1%, ACC will move 0.8%. And this is what makes correlation coefficient very close to my heart. As a matter of fact, far, far more better than delta. Your options experts will hate me for it. But believe me, I'm not an expert. I run a family office, a proprietary trading investment organization where all the shareholders are my family members. I don't have time for complicated jargon. I don't have the patience for it either. My job is to trade the markets to try and get the maximum possible bang for every rupee that I invest in the market and put food on the table for my family. So I will obviously choose something that suits my temperament and my purpose better than something else. And correlation coefficient suits me better because not only does it tell me how much will the stock move in the direction of a particular underlying asset, but whether it is negatively correlated. Now this is where delta fails. Now correlation coefficient goes from +1, 0 being the mean, and -1. In the case of ACC versus the Nifty, ACC is positively correlated with the Nifty at 0.87, which means if the Nifty is rising 1, ACC is rising 0.87%. Ditto for the fall. But what if the reading is -0.87? The Nifty could be rising 1%, ACC will fall 0.87%. Now you'll ask me, Vijay, what do I do with a negative reading? Hey, go short. Go short. These are negatively correlated instruments. When one rises, the other falls. So when one rises and you see that the options premium is mispriced. Now that is in part 6. This is segment 5. Segment 6 is how to see option premium being mispriced. If you see there's a negative correlation, go out there and see if the option premium is mispriced. Close your eyes, bang, bang, bang. You made your money. This is where correlation coefficient suits me better than delta. Like I said, the options expert may not like this advice from me, but hey, that's just fine. I'm not answerable to anybody except my shareholders. Now, segment 6, how do you know when options are mispriced? Now, when you enter, like I showed you on the screen, when you enter all the metric inputs, right from the strike price to the underlying to days to expiry, you will leave out the implied volatility blank. Why? Because you will basically see on your trading terminal, whether it's your mobile phone or your desktop, I prefer desktop, but hey, you could just basically see what the prevalent options premium is. Now you keep tweaking the implied volatility till you reach the same premium that is being quoted in the open market as prevalent at that time. You will see what implied volatility figure you have entered. Use your judgment. Is that high implied volatility maintainable? If it is low, it is maintainable. If it is high, not maintainable. So what's a good threshold? If I see implied volatility of 20, 25, 27, 30%, I said, hey, Option is mispriced. Write the option. I'm not buying it. Anyways, I'm an option writer. I'm not a buyer. Why? Because buyers are paying interest. Sellers are receiving interest. I would rather receive than pay. All right. This is how you calculate mispricing in options. Why are options mispriced? Because people are willing to pay a price driven out of emotions. In the beginning of the trading session, they feel they have 6.5 hours to toy around with and they will get out of the market. Disappointment starts to set in after 2:30 p.m. and option premiums start to fall. So it's a question of a few hours for somebody like me who has a little bit of money lying spare there. I said, okay, let me write this. By 3:30, if it gives me a good profit, fine. Otherwise, I roll it forward. It's giving me interest. I don't really bother. All right. So if your implied volatility is more than 25-30% and the option is also mispriced, go out there and do what you need to do. Friends, this is part 2 of the options video. I have a lot more to discuss with you where options are concerned. Please do not start putting real money on the line till you complete the entire series. These are all indicated hypothetical examples that I'm sharing with you. These videos are tailor-made as per request that I received from my online family members. Hey, you want me to cover some other aspect? I wouldn't know unless you tell me so. So the comment segment is open to you. And may I request something from you? Just because my videos are free does not mean that I should be getting such small number of views. You can help me if you want to and if you find these videos helpful by sharing my work with smart traders like yourselves, your social media groups on WhatsApp, Facebook, Twitter, LinkedIn, and where else you think is worthy. So if you haven't subscribed to my YouTube channel, I think you should. Give me a shout out. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And I thank you for your patience in being with me in this video this long. Till we meet again in my next options video. This is Vijay Bhambwani signing off for now. Have a very profitable day ahead. Bye-bye.